Despite the steep fall in the dollar index, the rupee maintained its stable undertone against the dollar, and the domestic currency hovered in the range between 74.60 to 74.80 in the previous week. A steep rise of over 48% in the BSE Sensex seen over the past 4 months period could have fueled the rupee to breach the 74.50 resistance in the normal circumstances, but the intervention stance from RBI prevented the rupee's rise as signs of export growth from July 2020 onwards is picking up, and the fall in exports may be much lower than we had seen in the last 3 months period from April to June 2020. During the period from the beginning of January 2020 till the end of July, we had observed a closer correlation between the Dow Jones and the BSE Sensex. In the said period, the Dow Jones fell by 7.25% and the BSE Sensex fell by 7.50%. In each calendar month from January to July 2020, the rise or fall in the Dow Jones guided the trend in the local stock market, although the percentage of change in the Dow Jones and BSE Sensex has varied in each month during the above period. Recognizing all the positive and negative factors on the currency front, we are of the opinion that the depreciation in the home currency till the end of March 2021 shall not exceed more than 3% from the prevailing level in the normal circumstances. The expected rupee depreciation is much higher than the prevailing forward dollar premium for end March 2021 maturity. In the period from end December 2019 till date, the rupee had depreciated by 4.7% against the dollar, which is the highest among the Asian currencies. Hence, one can reasonably expect the rupee to hold the 74.50 resistance and possibly bounce back to 75.25 75.50 levels in the days to come. The demand from importers has significantly reduced for both oil and non-oil imports, which caused a turnaround in the trade account to register a marginal surplus in June 2020. The dollar has been weakening against majors, but the overall Asian and EM basket has not appreciated to the same extent against the US dollar. In the last 3 weeks time frame, the domestic currency continues to trade in a narrow range with the resistance and support at 74.50 and 75.00 respectively, as the market is expecting the exports from India to pick up after 3 consecutive months of contraction. The need to maintain a stable exchange rate at or near the 75 level is imperative to boost export growth, as we are witnessing signs of external demand slowly rising. The 15th Finance Commission Chairman said the GDP growth in the current financial year would be in negative territory, and virus lockdown led to serious demand and supply dislocations. The RBI governor has indicated on Monday last week that their intervention stance is to restrict undue volatility in the exchange rate, and the central bank is not targeting any specific level for the rupee. As the US dollar index is declining rapidly, it is quite possible to see a test of 74.50 resistance yet again before any bounce back can be seen. In the background of the US dollar and INR interest rates to remain low for a considerable period of time, the market expects an easing trend in the local swap market. We are of the view that after considering the interest rate scenario in US and India up to the end of the current financial year, the possibility of the forward dollar premia for 1 to 12-month maturities to exceed 4% per annum can be ruled out, and one can be reasonably certain that the forward dollar premia shall be capped at 4% per annum across the forward curve up to 12-month maturities.